the last method of valuation that is remaining for us is the relative valuation, which we are going to see next. Okay, where the discount rate for explicit and terminal period can be different. Yeah, but here we are taking into account only one discounting rate, right? So the discount rate is same because the expected rate of return as of today, see, K is what? K is the expected rate of return you have from that investment, right? So when you are standing today, your discounting rate has to be same for all the periods, right? Your expected rate of return should be same for all the periods. Therefore, we take the discounting rate of return as one only, whether it is for terminal period or whether it is for the explicit period. Okay. So now we have the third method of valuation, which is relative valuation. Okay. So we say that the DCF model of valuation is the fundamental method. The value of firm and equity, which we have calculated, is nothing but the present value of the future cash flows, right? And it ignores the current level of the stock market, right? Because it does not take into consideration anything about stock market. It purely looks into the fundamentals of the company. And therefore, it is appropriate for comparing the investment across the asset classes. In long run, fundamental is the correct way to value any asset. Whereas the relative valuation is based on P ratios and host of other multiples. So everyone here have heard about the P ratio since it's quite popular in the media channel, in the research reports, among the broking firms, right? And therefore everyone had heard about the P ratio. Relative valuation, the word itself says relative, and hence it is used to value one stock against another. However, it cannot compare value across different asset classes. Right? It cannot answer the question that is the stock price overvalued or undervalued, or the stock market overpriced or underpriced, undervalued or overvalued. Right? So while you use the relative valuation, you cannot say that this stock market is overvalued or this stock market is undervalued. But however, you can answer a question that if I want to buy a technology stock, which one should I buy out of all this? Or if there is an IPO, there are 3-4 IPOs, which one should I buy and which is the best one? So these things can be answered. Because here we are making the comparison, and whichever is cheaper is the way to buy. This is how the relative valuation works. Let's say you're investing for the retirement and you're planning to take a buy and hold strategy, which involves picking some purely priced stock and holding them for several years. Which valuation approach you will use? Fundamental, absolutely. And if you're a short-term investor and you trade several times on a week in your broking account, E-Trade is a broking account, and rarely hold a stock for more than a month, you definitely can use a relative valuation approach. There are various methods, there are various standardized formula where you can use to do the method by using the relative valuation. Here your numerator will be standardized, the prices, and the denominator will be earnings, cash flow, book values, revenue. So for example, price to earning ratio, enterprise value to EBITDA ratio, market value to EBITDA ratio, or price to book value, right? Or price to sales, or enterprise value to sales. Or there can be industry specific variables like price per kilowatt per hour, price per ton of steel, price per click, price per labor hour. So for example, if you're comparing JSW Steel with Tata Steel, you can use price per ton of steel for comparison. Right? So you can use various multiples to use the relative to calculate the relative valuation.